All right. Well, thank you guys for joining. I hope you enjoyed Will's screen. He's very into it. Um, but, uh, but yeah, let's get started. So my name is Mark Lamonica. I'm the product manager for Morningstar Premium and morningstar.com.au. And today we're going to talk about preparing your portfolio for retirement. So we'll see how we go with this one. Before we get started, a couple things. So anything you hear from me today is general advice. I don't know anything about you, so I can't offer personal advice. But I would like you to ask questions. So there's a Q&A button on the bottom of your Zoom screen, or you can put them in the chat. And yeah, questions make it more entertaining for me, maybe for Will. I don't know if he's just sad after his screen goes away. And we have Shani in the room also eating Vietnamese food, which is making me hungry. But let's get started. So preparing your portfolio for retirement. So we're going to cover a couple different things today. We're going to talk about withdrawal rates, number one, because that's obviously important when you transition from saving to using your portfolio to pay for your life. We're going to talk about sequencing risk and how that fits into withdrawal rates. We'll talk about asset allocation in retirement, a little bit of controversy around that. And then finally, we'll do the bucket approach. So that's sort of a practical guide to how you can actually make this whole thing work. And it includes Shani's favorite slide because, well, I won't give it away. You'll see as soon as we get to that slide why it's her favorite slide. Okay. See if I can figure out how to use this. There we go. Look, I got a slide from Camp Fire, the fire movement. Most people in the fire movement don't understand the 4% rule, which we'll get to in a second. But let's talk about the 4% rule. So talking about withdrawal rates now. So what does that mean? Well, it means simply, as I said before, that you spend your whole life saving up money and investing money for retirement. Then all of a sudden you have to transition from accumulation to actually using your portfolio to take money out and pay for your life. And the big question, of course, is how much can you take out? So this is something that obviously a lot of financial advisors spend a lot of time worrying about, because the problem with retirement is that you don't know how long you're going to live and you don't want to run out of money. So that's a very bad thing if you run out of money. So using averages, average lifespans, anything around that, well, that can be a little bit informative. It doesn't really matter. It just matters how long you live. So back in 94, there was a financial advisor in the US, Bill Bengen, who came up with the 4% rule. And what he was trying to do is he was trying to answer that question. The question being, how much can my clients, in his case, safely take out of their portfolio without running out of money before they die? So what he did is he went back, and we'll talk about sequencing risk in a while, because he understood that sequencing risk is really important. So it doesn't really matter what your average return is. Well, it does matter, but more important than your average return is the sequencing of returns right around when you retire. So you do not want to retire in a bear market. And we've got a slide next that shows you why and uses an example. But basically, you are not, if there's a bear market, you're in your 30s or 40s or 50s even, it's not that big of a deal. You're really looking at those average returns over your retirement horizon, because you can make up those returns. The problem is, of course, if you retire in a bear market, start pulling money out of your portfolio, you're pulling it out at really low valuation levels. So that can be a problem. So anyway, this financial advisor went back and looked at historic returns. So once again, this is 94. I think he went back to 1926 and he looked at all these different combinations of returns and basically looked at if anyone was to retire between 1926 and 1994, what the sequencing of returns was, to see, okay, even if you retired in a really bad time, what would that do to your retirement outcome? So he ran all these tests and he came up with the 4% rule. So basically the 4% rule means, and the mechanics of the 4% rule are that you can take 4% out of your portfolio. So if you retire and you have $1 million, you take $40,000 out of your portfolio, and that's what you live on. And then each year, that number increases by inflation. So it's not a static 4%, and it's not 4% of your portfolio every year. Other people think that. So if it goes down, you get less. No, it's 4% increase by inflation. And what he found is that over a 30-year retirement period, basically nobody ran out of money, regardless of these different return scenarios, these historic return scenarios, and that's important. You didn't run out of money. So 4% was a safe withdrawal rate. Now, a couple things to think about, and why I was making fun of this FIRE, so this financially independent, retire early. These are the people that want to save a bunch of money and then retire when they're 30 and live in like a trailer somewhere and not do anything. But they're independent. That is their independence because they don't have a job. They also can't afford to do anything, which makes their 50, 60 years of retirement seem horrible. But that's a personal opinion. Anyway, this 4% rule has caught on with the FIRE movement, but even though they want to retire in their 30s, they decided not to read any details around it because it was for a 30-year time period. So if you retire when you're 30 and you run out of money 30 years later, you're in trouble. But anyway, that's my little rant about FIRE and attention to detail and making decisions about retiring when you're 30 without reading about what you're doing. All right, so that is the 4% rule. Now let's look at the 4% rule now. So this was done in 94. It was done in very different market conditions. But before we go into that, first, let's look at the sequencing of returns. So this is an example. One very bad time to retire recently would be in the year 2000. So if you think about 2000, the markets had had a huge run up, the tech bubble. We can call it a bubble because it's burst now. We'll see what we get to call what's happening now. But so yeah, retiring in 2000 was really bad. And so you can see what happened in this portfolio. So this is the example. This person had $1 million. So they retire when they got 65. They took out $40,000 a year. Then they increased this by 2% a year to represent inflation. But you can see what happened very early in their retirement, 65, 66, 67, the markets did really bad. So this person who retires at 65 finds a couple years into retirement, 3 years into retirement, their portfolio has basically halved, which is a really big problem. And you can see what happened to them. They were taking out this money. The market was going down. They, of course, weren't saving and investing anything else. So yeah, this is what we're talking about in terms of sequencing of returns and how bad it can be. The other thing they've, of course, run into, particularly if you look around this 2000 period, which why it was so bad, is then, of course, when they were 73 and 74, this is the GFC. 73 is the GFC, this 36.5% reduction in the portfolio. So that's why we're worried about withdrawal rates and when you retire and things like that. So I wanted to provide a little bit of that perspective. So let's go back to the 4% rule and talk about some of the considerations that if you're about to retire, that you need to make. And the other thing that I'd say about the 4% rule is withdrawal rates are important for everyone, because when we've gone through and we've done these portfolio construction episodes, we've used the withdrawal rate to actually assess how much money we're going to need, because it's very hard for people to figure out what a lump sum means. So like, what does $1 million mean in terms of retirement? It's much easier for us to think in terms of what we've been trained to think about is salary. So that's why it's easy to, that's why you use this withdrawal rate to translate a salary or the amount of money you need to take out of your portfolio every year to a portfolio value. So we did that in the examples that we walked through in the portfolio construction episode. We did that. We used Shani as an example. We did a podcast on how to construct a portfolio. So we used Shani as an example where she used how much money she wanted to spend on Vietnamese food when she retired. And then we used that withdrawal rate to figure out the portfolio value. So this is important for younger people as well. If you're longer to retirement, that's how you can estimate how big your portfolio needs to be. But anyway, let's go back to the 4% rule. So one thing about the 40% or the 4% rule, the 40% rule would be great. I think you'd run out of money quickly. You'd have to die soon, but you'd have a couple good years. But anyway, the 4% rule assumes that, and what he tested, what this financial advisor tested, was a 60-40 portfolio. So 60-40 portfolio is 60% equities, 40% fixed interest. So let's talk about what that would mean right now. So let's start at the 60%. And we need to look at valuations. So I could do this with lots of other valuations, but we are using the CAPE ratio, so cyclically adjusted price to earnings. So what this does is it goes back. One of the problems with looking at a PE, a 1-year price to earnings ratio, is that they both bounce around a lot. So earnings bounce around a lot. This is a perfect example. Earnings for a lot of companies fell significantly in 2020. So we probably even have overinflated PEs because the E is down. But CAPE looks at a 10-year period, which smooths out basically the business cycle and different sort of rises and dips in earnings. And it includes inflation in it as well. So inflation adjusted earnings. So it gives us a little bit of a smoother look at this. But right now, or at least this was a couple months ago, the CAPE ratio was sitting at 26.1. So that probably doesn't mean anything to you, but that's pretty high. So historically, it's been between 10 and 20. There have been 3 times when it's been this high. So Black Tuesday, which was right before the Great Depression, not a great time. That tech bubble that I was talking about, that 2000 period, and right before the financial crisis. So we're not in great company. If we go back and look at what happened after all of those different events where this thing spiked. Don't wave at people; it's distracting me. Shawnee's waving at people. So yeah, you can see that's before the tech bubble. But anyway, not great times. But valuations matter, and the reason they matter is they matter for future returns. So if we look at this 60-40 ratio, we need to think about, if you're taking 4% out now, we need to think about what's going to actually happen with your returns. What is the likelihood from a sequencing of returns perspective that you're actually getting decent equity returns? So all of those periods. So let's go back to those different periods. And I've got some stats here. So go back. So if we look at, all right, so if we look at the Dow Jones, so there was no S&P 500 back then. If we look at it in 1929, what happened in that next decade? Well, the Dow was down 51% after basically starting in October, or starting in 1929, looking 10 years out. It fell 51%, like for a 10-year period. So you're 51% below where you were in 1929. Not a great time period. If we go back and we look at 2000, and we'll look at the S&P 500 at this point, 2000 was also really bad. If you look 10 years out, now remember that 10-year period also included the GFC. So if we look at that, you're down 13% in the S&P 500 over that decade. And then if we look at the GFC, we sort of isolated from 2000. If you retired during the GFC, it was actually up. So it was up 70%, which is good, but that's still only a 5.65% annualized return. Now, why is this important? Well, it's important for a couple of different reasons. Number one, if we are going to use a rule in 1994 and we're going to look at back-tested data, we do need to be cognizant of what has changed. Well, one thing that's changed is equity valuations have gone way up since 1994. So you can see on here, there have been a lot of periods where it's been a lot higher than it's ever been before, other than this Great Depression, this pre-1929 period. So we are at very high equity valuations. And what that means is that we're at high equity valuations. We need to have lower future expectations of returns. And it kind of drives me crazy, but I follow all these different, we'll call them millennial, like investing, Instagram accounts and things like that. And the return expectations that are baked into this. And remember, a lot of the people that are doing this have never been in a down market, right? If you're in your early 30s now, you have never seen a down market in your entire life. And all these people that are saying that you're going to get these huge equity returns off of where we are right now, I think it's a little misguided. Shawnee actually got in like a little Instagram war with somebody the other day because she was writing about how she did not agree with their returns. All right, so that's the 60%. So you need to think about what those returns are going to be in the future. Let's look at the 40%. And that's, of course, bonds. So if you go back historically, sitting in 1994, if you went back and you looked at fixed income returns, they were 5 to 6% a year on average since 1926, which is really good. Now, why were they good? They were good because interest rates were falling. So bonds, of course, move inversely. The price of a bond moves inversely to interest rates. So when interest rates go down, bond prices go up. So that's a really good thing. Where do you get returns from bonds? You get, of course, potential price appreciation. You also get, of course, the interest that you're paid. Now, what has happened? Bond rates are at close to zero. So very, very low. So I think when I looked at this maybe last week, 10-year treasury yield was 1.45% in the US. Similar case here in Australia. That is nothing. So you're not getting any income out of this. You're not getting any interest payments. And interest rates are so low that you are not going to get, I guess this is my opinion, but from a practical standpoint, you're not going to get price appreciation in bonds. So that's a problem. So when we went back and looked at a 4% rule, when we were looking at historic returns and all these different sequencing of returns, when he's looking at the 60-40 portfolio, he's still getting 5 to 6% a year on average out of fixed income, which is really good. You're not going to get that. I mean, I, of course, can be proven wrong, but there are very few scenarios not involving negative interest rates that allow you to get to those return levels over the long term. And what I wanted to use was an example, because for people who are following the bond market last week, we saw just that. So even though all these central banks around the world have come out and said that they are going to keep interest rates low for a long time, they're not the only ones that have an opinion in this whole thing. And we saw yields jump last week. So in the US, well, in Australia is actually more. So in the last 2 weeks, Australia, the 10-year bond went up 70 basis points. So there's 100 basis points in a percentage. But that's a big move for a bond. In the US, they went up 23 basis points. In one day, actually, went up 23 basis points on Thursday of last week. Aussie went up 20 basis points at the same time. And what I wanted to show over this period, this 1 month period, is looking at this Vanguard International Fixed Income ETF, hedged, so it is hedged. There's no currency involved. I want to take currency out of it. You can see there was a really big drop. Now, it's recovered a little bit this week, but still, in 1 month, it's gone down close to 1.5%. That's a lot for bonds, right? People think that bonds don't move a lot, and generally they don't move as much. They don't have as much volatility as equities. But it's a problem. So two different things are happening here. It's very likely, if there's any scenario where interest rates go up, you're actually going to have losses in your fixed income investments. You're not going to get any income, and you're going to have losses. So if you hold this thing to maturity, if you're buying individual bonds, you can hold a bond to maturity as long as the company or government that you've lent the money to pays you back. You know what you're going to get back from a principal perspective. You're getting no income practically because the yields are so low. If you buy an ETF or a fund, which is most likely where people do it, you could have pretty significant price drops if interest rates go up. And at some point, they have to go up, even though central banks have said that they're going to keep them down. And what happened, by the way, with this little jump is Federal Reserve in the US and the RBA here jumped into the markets massively and bought a bunch of bonds to try to keep those yields low, which obviously worked a little bit, but well, I guess I could do this forever, but we will see. So the whole point about withdrawal rates is when you're thinking of your withdrawal rate, look at the different components of where that famous 4% came from. Personally, I'd be a little more conservative given where we are from a market perspective. But think about that withdrawal rate and what you actually want to use, and think about how conditions have changed since 1994 when he first came out with this 4%. The one other thing that I would say, I know this sounds very gloomy, but people that are retiring now have benefited from really good market conditions over their lifetime, particularly around the periods where they were at peak earning power. So hopefully, if you set a goal and establish a goal, you should be well above it, because just the market returns in everything, so in fixed interest, in equities, in housing prices, and everything have been so strong since basically the early 80s. Hopefully you're in pretty good shape and you can fund your retirement with a lower withdrawal rate, but something to think about. All right. Getting weird messages. I thought people were asking questions, but no. But there is one question I'll get to in a second. All right. So let's talk about asset allocation. So the other thing that happens, of course, is you are transitioning from a period where you are saving, accumulating, investing money to a period where you're taking money out. But nobody ever thinks about asset allocation after they reach retirement. So even all these goal setting exercises that we talk about around setting a goal, picking an appropriate asset allocation, then finding the securities, that is to get you to retirement. But of course, retirement can last a very long time, particularly now as lifespans are increasing. So the big question, of course, is how should you allocate your portfolio as you get into retirement? Now, there was an old rule of thumb that your allocation, your equity allocation, should basically match your age. So the idea is obviously as you get older, it gets, sorry, not your equity allocation, fixed interest. So the idea is obviously you transition from more equities into fixed interest, but that does run into this longevity risk. And what we're talking about here is something called the glide path. And basically the glide path is as you get to retirement and move into retirement, you can see right here that more of your portfolio gets allocated into fixed interest. But what you are combating right now, particularly, is number one, people are living longer. That's hopefully going to continue to increase. If you live longer, you should probably have a higher equity allocation. The other thing, as I said, is you're not getting any return from bonds, which makes it very difficult to transition your portfolio where it's majority fixed interest when you're getting next to no return. You're getting next to no income. You're probably going to have negative returns going forward. So that is the big question, how much to allocate into stocks. So what we wanted to do, of course, is hopefully provide a approach that can help you do that. So we are going to talk about the bucket approach. So this is kind of the practical approach to hopefully answering some of those allocation questions. All right, so here we go. Well, this is Shani's favorite slide, and it's not because she likes bourbon or beer. She is a fan of the first bucket, KFC. So anyway, I want to talk a little bit about the bucket approach. So this is a practical approach that Christine Beddens, who is a Morningstar market commentator in the US, talks a lot about. So I will try to steal Christine's thunder here and talk a little bit about the bucket approach. And it's an approach, of course, to try to make this transition. How do you start taking money out of your portfolio and make sure sequencing risk doesn't impact you, make sure that you still are taking on enough risk in your portfolio to not have longevity risk, basically that you live a very long time, impact you as well. So let's talk a little bit about the bucket approach, and then we can go to questions. So we're starting to get questions. So keep sending those through if you want. Except for people in the room, stop sending comments and questions. It confuses me. Let's talk about the bucket approach. Okay, so the bucket approach is basically, in this case, a 3-bucket approach. So let's go through them all. So let's start with KFC. So in KFC, which is essentially cash, you want to figure out, and we have 1 to 2 years on here, but it can actually be longer. You want to figure out what you're actually going to take out of your portfolio in the next couple years. And I'll talk about a modified bucket approach in a second. So what that means is, if we're using the same example, $1 million, you want to take out 4% a year. So if we're doing 2 years, you guys can do the math. You want $80,000 just sitting in cash. So then you've got the next couple years paid for. Then you've got these 2 other buckets. So we've got bucket 2. So we've got intermediate term assets. So what we're looking at here is we're looking at intermediate term bonds. So number one, this is where your fixed interest or even long-term bonds, any bonds sitting in there. And then also you can have dividend stocks in there. So safer, lower beta securities that have secure dividends. You can have sitting in that bucket too. And yeah, you're looking at sort of an intermediate time horizon there for those assets. Hopefully they're generating some income. Now, once again, you've got a problem because you're not going to get any out of fixed interest right now, but hopefully at least you've got some blue chip dividends paying stocks in there. They're generating some income. And of course, that can help replenish bucket one. And then our third bucket is we have long-term assets. So long-term assets is think equities. So this is where you really want to go into equities. You want also potentially things like junk bonds. So high yield bonds, which perform a lot like equities. So those are companies that have very low credit ratings. And really what you're trying to do is if you're a bond manager, trying to assess the ability of that company to stay in business. So of course, if they do, credit quality will go up and you'll actually make some returns on those. So that is bucket three. And basically what you want to do is you do want to look at sort of the allocation between these different buckets, whatever works for your goals and comfortable, and you'll rebalance between bucket 2 and 3 to make sure those are whatever your long-term asset allocation is. And then you'll simply replenish this first bucket. Now, I think it's a really good approach. Right now, it's a little bit challenging. So I can talk about, and one of the weird notes that I got from somebody in the room that will remain nameless, although people can probably guess, is that my mother's on here. So she can actually hear what's going on in her portfolio now. So at this point, I sort of follow this with my mother's portfolio, but a modified bucket approach where since you're not getting anything in fixed interest, and I really don't think that you're going to get anything but negative returns and a lot of it, we basically set up something where she has more like 5 years, 6 years worth of living expenses just sitting in cash, and then the rest in equities. And they are more conservative equities. They are dividend paying, what I believe are pretty conservative equities, low beta, so they don't have a lot of volatility, or they don't have as much volatility as the market. Equities, and yeah, dividends sort of replenish that cash bucket. So that's sort of the approach I've taken. I basically eliminated that middle bucket just because at this point I didn't think it was a good environment to buy fixed interest in. So that's the last thing I wanted to touch on, and then we'll start getting the questions, is cash. And we talk a lot about cash. We have talked about cash a lot in some of these previous episodes. But generally, yeah, holding cash, if you are younger, having large cash balances isn't the best thing to do. Inflation is just going to eat away at that. And then it's better with those long time horizons to actually put some money into riskier assets like stocks. But cash, once again, you get no return off of it, but cash does provide, particularly if you're around retirement or going into retirement, it provides a lot of flexibility. And it provides flexibility for you to take advantage of a market drop, for example. It certainly provides you with safety that allows you, in this bucket approach, allows you to have 2 years, 5 years, whatever it is, cash on hand, which means that you won't have to sell your portfolio. So sell off stocks if the market falls significantly, because that's what you don't want to do. Over time, hopefully the market will recover, but you need to get that time. And the only way you can do that, if you're retired, you need your portfolio to generate income. The only way you can do that is by not selling during these big slumps. So I was looking at 10-year returns from sort of the top of the market, 10 years out, but the returns were pretty good if you look at the bottom of the market, right? So if you do have an opportunity to reinvest, if you have some cash on the sidelines that give you that flexibility, if you can reinvest when valuations are lower, you would have very good returns, even if that 10-year aggregate period from sort of the top 10 years out aren't great returns. So just something to think about with cash. All right, so let's see what questions we have. Here's a question your mom's on. All right, so we've got a question from Paul. So Paul's asking, what is your view on TIPS? TIPS are inflation-protected bonds, or Treasury inflation-protected securities as an investment right now. Well, I am not an analyst, so I can't give you my opinion on specific securities like TIPS or security types, but let's talk about what a TIP does. So if you are a fixed interest investor, what is something you're really concerned about? Well, you're really concerned about inflation. And the reason you're really concerned about inflation is, particularly if you're going out to longer term bonds, you are locking in a certain interest rate. So in the example that I gave, that 10-year treasuries in the US are trading at like 1.45%. Well, that means if you go buy the real bond, right? This is not ETFs and funds. They work a little bit differently. But if you go out and you buy the actual bond, you're getting 1.45% on your money. Well, if inflation goes up to 2%, you're in a lot of trouble. So what a tip does is it will actually adjust the principal of the bond. Well, the mechanics aside, what it will actually do is it will give you back extra return, extra money based on inflation. So it's one less thing you have to worry about as a fixed interest investor. Now, of course, anytime you buy a tip, the way that it is priced is expectations for inflation are priced into that security. So once again, if the market thinks inflation is going to be 2% a year for the life of that security, and it is 2% a year, you're really not getting anything because that's built into it. What it does allow you is, if inflation differs from what expectations are, then you will actually make a pretty good return. So really the big view is sort of what your view is, Paul, on inflation and what's priced into that security. So just look at sort of inflation expectations and then look at how inflation may or may not impact you, because inflation impacts us all differently, right? So if you are younger, what has really, if we're talking about inflation, what has really impacted you is, of course, here in Australia, housing prices, right? So the inflation in housing prices, and rents have stabilized and actually come down, but housing prices continue to take off. So if you don't own your home and you're trying to buy a home, that's a huge problem for you. So if you own your home, you don't really care about that portion of the market, right? That portion of inflation. So it's looking at that overall bucket that represents inflation that governments put together, the Consumer Price Index, and thinking about what portions of inflation affect you. And so that's something that's important to do. All right, so we've got a question from Belinda. So she's saying that 40% is not to be bonds. Could it be another form of fixed interest, such as hybrids? Okay, so hybrids are, as the name suggests, they have both debt and equity features to them. So yeah, they're not pure bonds. They're certainly not pure stocks. I would personally consider them probably more in the fixed interest arena. Like, there are all sorts of different types of fixed interest. But basically what you get out of a hybrid and why people like them so much is you do get, and they've come down, but you do get a higher income level. So people have looked for those instead of traditional bonds. They've looked at hybrids because they're getting more income. You get franking credits, and obviously people are pretty into those. So there are some benefits to hybrids, but just remember, like, hybrids are not as secure as a bond. They're generally issued by banks at the end of the day because they need them for their capital structure. But yeah, I don't know. I don't think the banks are going to go out of business. Make your own call. So you're probably pretty safe from that side of things. So yeah, I mean, I would consider hybrids kind of more fixed interest, but once again, there's a lot more risk, default risk, than you would get from pure fixed interest. So somebody asked, I'm always good at answering these questions, can we get a recording of this? Yes, so we're recording this. We will put this up on our website, and we'll put that up there. So we got a question from Linda saying, what percentage do you recommend would be realistic in buckets 2 to 3 for a 65-year-old? Listen, it's hard for me. I obviously can't give any personal advice, and obviously I don't know what the circumstances are. So, what I would do is, think about your life and what your expenses are, and everyone's different, right? You could be a renter who obviously has less control over what their housing prices are. You could have your house paid off. I think it's really looking at how comfortable you are holding, how much cash you want to hold, and a lot of that has to do with your portfolio size as well. So sorry, I can't be too much more specific than that, but look at Christine Benz. If you just Google bucket approach, or bucket method, Morningstar. All these articles will come up from Christine Benz, and she has all sorts of different like bucket portfolios for different types of risk and return expectations. So that's a good place to look. And you can email me, Linda, if you want. I can send you some of those articles. All right, so we've got a really good comment from Michael. So he's saying, I use a slightly different approach to fund my living expenses in retirement. What I do is I use corporate bonds to pay for my basic living expenses and the stock market to make my cream. This way I know that no matter what the market does, I will always be able to meet my daily living costs. Comments. Yeah, listen, the ideal situation that all of us would like to be in is a situation where the income generated by our portfolio pays for our life. Right. So this idea of generating enough passive income to pay for our life is very attractive. Right. So obviously, if we're looking at stocks, dividends can change. That is something we've experienced in 2020. But yeah, that's sort of an ideal situation. Now, yeah, I would say if we look at sort of the approach that Michael's taken, sounds really good, right? It's sort of dividing your life into what are basic expenses that I need. So housing, food, et cetera, whatever else you consider basic. And then, yeah, everything you want to do, whether that's travel, everything else you want to do, Michael. Yeah, I mean, I think that seems to be a really good position to be in. Yeah, the only risk would be the credit quality of those corporate bonds. So once again, I was making jokes about governments going out of business, but governments can just print more money. Corporations can't. So there is obviously some risk to corporate bonds. But yeah, it seems to be, as long as they're pretty high quality or you're pretty diversified, that seems like a really good situation to be in. I clearly did some math wrong, because I've had a couple of comments about how I don't know how to do math, that 4% of $1 million is $40,000, not $4,000, and 8% equals 80,000. So I'm sorry, I apologize for that. I don't have my calculator. But yeah, sorry about making that comment. A couple of people said that. All right, so we've got a comment from Vidania saying, could the cash in bucket one include fixed interest ETFs? Listen, I would be concerned about fixed interest ETFs. So, the example that we're using that we put up on the screen is, you got to be prepared for these things can go down, and they can go down a lot. So if like interest rates steadily move up, and I know what all the central banks have been saying, but if we were in a period where interest rates steadily went up, or inflation returned and started going up, those ETFs are going to go down. So that would be my concern. The difference, and I know people hate cash because you don't get anything from cash, but what you're buying yourself is really peace of mind. And to get any kind of yield, right? So if we look at fixed interest ETF, could be anything, right? So it could be anything from like short-term government securities, which have very low durations, which means that if interest rates go up, they won't get impacted as much. But it could also be a fixed interest ETF, could be, as we were saying, it could be junk bonds, corporate bonds, it could be long dated government bonds. All of those are going to move more with interest rates. So if interest rates go up, they're going to go down a lot more. So I would just be careful about that. So if you're in a fixed interest ETF that's very short term, so we're talking US T-bills, very short term bonds, yeah, maybe, but I just be careful that people don't think bonds move, but they move. Yeah, same question from Stephen around hybrids. Are they too risky to replace bonds in a balanced portfolio? Yeah, I mean, they're different. They're riskier than bonds. And what that basically means is that if a company goes out of business, well, basically everyone's wiped out, except for potentially the bondholders. So if there are assets, if there are enough assets, they probably wouldn't go out of business. So there are enough assets, as equity holders, you're the last on the ladder, but you could still potentially get a payout if a company went bankrupt, but it's unlikely. Bonds are highest on the ladder. Hybrids are down the ladder. So if we're looking at who's going to actually get payouts, so hybrids are riskier than bonds, right? So the company wouldn't necessarily have to fully go out of business to not pay off its hybrids. As I said, a lot of them are issued by the banks. I don't see a realistic scenario, knock on wood, that any of the big four banks would go out of business, but anything could happen. So just think about that's the risk that you have with hybrids, and of course there are risks also involved around certainly them continuing to pay to pay off interest. So you can think about that as well. And I'm going to show you, since we've had some questions about hybrids, let me figure out how to share my screen again. All right, just so people know, we do have hybrid research. It's my shameless plug for the product. So hybrid. So we actually team up with a company called Bond Advisor here in Australia, and we get their hybrid research. So if you want to discover investments, hybrids, you can see all the different hybrid issuances. So we've got 50 in here if you want to read about those specific issues. So obviously they are the experts, not me, but you can go in and read about hybrids. Oh, here's one for you, Mom, if you're still on here. You know, she's 2 bottles of Sauvignon Blanc deep and wandering around the neighborhood now that she's been vaccinated. But John says, your mother's strategy sounds exactly what I've done, about 1/3 cash, 2/3 quality dividend paying stocks. Only one speculative stock held 17 years. Well, hey, that sounds pretty good then. It was a good speculation. Hopefully for you, that was CSL. Yeah, big question is the low interest rate on cash. Any alternative suggestions? Yeah, I mean, that's John, I think that's the problem. And, the way that I've looked at my mother's portfolio is I've looked at buy holding cash, even though there's basically no return on it. And I used to actually buy term deposits with it, and it's basically useless now because you don't even get anything on those. Because there's no return on the cash, the way that I sort of justify that is it means it can be a larger equity allocation because it's kind of not investing in fixed interest because I don't think it looks great right now. And that could change if interest rates go up. So that's kind of the way that I've sat there and, bitten the bullet about having no return on the actual cash. It's peace of mind and it allows more of an equity allocation. So that's just kind of the way I've been thinking. There's no, there isn't really any sort of magic solution to the fact that you're not getting anything for cash. All right. So we got a question from Kim. I'm coughing for some reason. So Kim says, a question about commodities, where you see silver as an investment and hedge against inflation compared to gold, compared to cryptocurrencies. So Will has perked up with the mention of cryptocurrencies. So Will, who is our videographer and also the producer of the hottest investing podcast in Australia, Investing Compass, is very into cryptocurrencies. Okay, so let's talk about them. And once again, I am not an expert on anything, let alone this. But so let's talk about silver. So silver, at the end of the day, does have a lot of industrial uses. So, I think silver's value is driven significantly more by its actual industrial applications and the demand for that. And there's been a lot of talk around silver that like Cat Guy in the US and the rest of the people on Reddit are been talking about like a short squeeze on silver. So who knows what's going on with all of that, but silver's been in the news a lot lately. So let's talk about gold. So gold, despite the fact that obviously there is a jewelry side of gold, most of gold is actually driven by investors. So I think gold is a lot more of a cleaner thing to look at than silver. But yeah, so gold for thousands of years has been something that's been used to retain value. And yeah. So what does that give you? So a hedge against inflation. Certainly a lot of the gold bugs will tell you that. That's a thing. Don't laugh at that. Gold bugs, right? People are into gold. People are very into gold. People keep like gold bricks and stuff like that in their house, and coins. But anyway, yeah. So gold certainly people have you believe that it that will help with inflation. I I think if we look back over time, in many cases, it has. So that's one thing you can do. The other thing, of course, is cryptocurrency. So cryptocurrencies, for those that did not listen to Will's favorite episode of Investing Compass on Bitcoin, even though we trashed it a little bit. So cryptocurrencies also are looking at, are also thought of as potentially a hedge against inflation. I would say that there hasn't been as much of a track record. So we can go back thousands of years with gold. There hasn't been as much of a track record with crypto. But if we think about Bitcoin, we'll talk about Bitcoin, for example. One of the things that a lot of people point with it, Bitcoin, is there's a finite amount of Bitcoin that can be created. So of course, if there's a finite amount of something that can be created, if there's inflation, in theory, it should go up. The only thing that I would say is the prices are so high right now. I don't know. From a personal point of view, it's gone up so much. I'm not sure we can sort of say that it is fairly valued now, and that if inflation goes up a couple percent a year, it will just go up a couple percent a year because of that. Like, I think there's a lot of speculators out there, and we'll have to sort of see what happens with crypto. I don't know. Will's going to be very angry at me, but we ordered him some new podcast equipment, so I think I'm on his good side, at least for a couple days, maybe. So yeah, we'll have to see. We'll have to see with crypto what happens. I would just say that it does seem to be driven a lot by speculators right now, and it's had a huge run. So I don't know if this is maybe the best entry point. I'm not sure. Will is probably going to go home and buy some tonight, but yeah, I just don't know if it's the best entry point. All right, so we've got a question from Paul about annuities. So let's talk about annuities. So annuities are interesting. So what an annuity is basically what you were doing, and there are all sorts of different kinds of annuities. So Paul is talking about a couple different annuities. But annuity basically means that you are turning over a sum of money and you are buying an income stream. Now, that income stream can be a finite, and they can get very complicated. It can be a finite amount of time. You're buying an income stream for 10 years. It can be a lifetime annuity. That means you're going to get that income stream until you die. Now, the advantage of annuities is what they take away is that big risk that you have around that 4% withdrawal rate, right? Is that you don't know when you're going to die. Retirement planning would be really easy if you knew when you were going to die. But that's not the case. So your risk is longevity risk. You outlive your money. An annuity is a way to take away that longevity risk. So yeah, they're interesting products. I'm trying to think of something. They've been controversial. Like an annuity works very well if you buy one when you're 60 and you live till you're 105 years old. They work really poorly if you get hit by a car walking out of the place that you bought the annuity from, because of course all your money has already been given to the insurance product. So one thing that people think about, or people use annuities for, so much like the comment that we had earlier, that Michael made, is there a portion of your living expenses that you want to fund with an annuity? So you know that money is coming in. So whether it is your housing expenses or your basic expenses, that can give you the opportunity to still have investments, still get the potential upside of those investments, and your heirs get the upside if you get hit by the car walking out of the annuity place. But yeah, that's what's attractive about annuities. And I think we're going to hear a lot more about annuities because there has been more focus by everyone. So governments around the world and a lot of people on, how to make this transition from a portfolio into actually living expenses. And this didn't used to be the case because a lot of people were on pensions. So whether that's a private pension or a government pension, a lot of people, a pension basically takes away that longevity risk, right? Because it's going to pay you a certain amount until you die. So you know exactly where it's going to come. If we look at the reforms that have happened in Australia, as we start transitioning to people whose more and more of their retirement will come from their own super, you're bearing all that longevity risk. So people have talked about annuities as a solution to that. You can read our note on Challenger. which is a big annuity provider here in Australia. And they'll certainly talk about some of the transitions that have happened with annuities. Oh, so Paul is an expert on annuities. So showing me up. Yeah, but so he just thought it should be covered, and it should have been. I should have had that in there. So that was a really good question, Paul. Maybe you should come on and talk about annuities, and I'll play Shawnee's role by eating Vietnamese food and sending snarky messages over the chat. So maybe we can arrange that. Okay. So you're in New Zealand, so you can come here. So you can come be on an episode of whatever we're calling this thing, of our webinar. So you can fly here. We just can't go to New Zealand. So that doesn't seem to make any sense to me, but what do I know? All right. So we've got a question about oil and gas. So we've got a question: is oil and gas still an attractive asset class to get in now, or the renewable green energy is a better choice? Okay, so interesting question. But once again, I am not the expert. I will talk a little bit about what our analysts talk about. So anyone who's sort of seen the last year has been following oil prices, for example. So oil prices plunged significantly going into COVID, because obviously the idea is lower economic activity means we're going to use less oil. There's a bunch of other stuff going on in the oil market between sort of Saudi Arabia and Russia and everything else. There's, of course, fracking in the US, which sort of upended the oil market. So there's a lot going on it. Our analysts, and oil's recovered. And a lot of oil stocks have recovered until Monday when I sold it. I used to own ExxonMobil, and the price actually came back up. But yeah, so oil's doing a little bit better. The thought is, obviously, as we get into more of an economic recovery, oil will continue to go up as there's more economic activity. That's certainly what our analysts think. So they think from just a pure, like, if we look at equities, oil companies got very, very cheap. So you certainly see in Australia, we had 5-star ratings on Woodside and other oil providers. Yeah, the question is sort of how long this whole thing runs for. I think in terms of renewable and green energy, that's of course the big question. So yeah, the question is, how are you going to invest in renewable and green energy at a oh geez. So Paul, sorry, we'll get back to this. Well, first I'll do this. Yeah, so I think it's how you're actually going to hit those asset classes, or how you're going to hit that renewable green energy investment. So yeah, I think we've got a piece coming out soon by Lex Hall looking at this very issue. But anyway, that was supposed to be my summary of what our analysts do. So update on Paul. Paul is also a qualified therapist, which I think he is directing towards me. Most of the people I go for therapy, which are primarily bartenders, are not qualified. But Paul is, Paul's getting his PhD. That's exciting. So annuities to psychology. So yeah, I think Paul thinks I need to see a psychologist. So we'll work on that. But Paul, we've got a question for you. What is your opinion of lifetime pensions as an option for over 60s? Stephen, yeah, listen, I think once again, it depends. I mean, the big question is, how much of your portfolio would you want to put in that lifetime pension? It eliminates that longevity risk. It depends what you want to do with your money. Are you trying to pass on your money to potentially future generations? There's a lot of different considerations. So you should ask Paul. But yeah, I think annuities. So as an American, I'm also Australian. I'm a citizen now. I don't actually think my mother knows that. So maybe I shouldn't have said that. She's probably going to cry now that I'm not coming home. But yeah, no, as an American, you get a form of basically annuities through Social Security, and I actually have a pension, a real pension from my previous job, which is which is scary. I think when I'm 65, I get $18,000 a year until I die, which by the time I'm 65, will be able to buy nothing with that. So yeah, I mean, I think once again, it does remove that longevity risk. Maybe there's a balance you can put in your portfolio where you're getting a certain amount from annuities and you still have the upside from having a portfolio. All right. So let's leave it there. If anyone has questions, please email me or other therapist recommendations. Once again, I can't go to New Zealand to see Paul for my therapy sessions, but you can try to diagnose me over email. But anyway, thank you guys for joining. What's today? Thursday. We'll be back on Tuesday talking about something else. I don't remember exactly what that is. I'll find out. How about that? This will be good. Sorry, I'm scrolling. Oh, so Tuesday's a good one. How low interest rates affect asset values. So I think that will be a good one. But anyway, tune in Tuesday. Thank you guys for joining. Really appreciate it. I will talk to you soon, and email me if you have any questions.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.